Hi everyone, this is Jesse with the Jesse Bandwidth Group with eXp Realty, and welcome to your 2022 National Market Update for the months of February and March. Now, I'll be touching upon 5 key subjects here. Number 1, Bank of Canada interest rates. Number 2, national home sales. Number 3, supply and demand and immigration. Number 4, I'll be talking about home lines of credits. And finally, number 5, bank interest rates and how they're steadily increasing, the difference between fixed and variable interest rates. Bank of Canada interest rates. As you've probably already heard, the Bank of Canada has increased its target for the overnight rate by 0.25% to 0.5% for the first time since 2018. On the other hand, inflation hit 5.1% in January. This is the highest level since 1991. And core inflation, which measures the exclusion of food and energy prices, now is above average of the Bank of Canada's target 1 to 3% target band. It can be expected another 2 to 3 hikes before the end of the year. The expectation was 6 to 8 hikes. Now that's probably off the table due to the Ukrainian-Russian war that rages on. Number 2, national home sales update. Now, January was peak insanity for house prices. Statistics released by the Canadian Real Estate Association, CREA, show national home sales remained historically high in January 2022. The demand was up 1% month over month seasonally, adjusted and still 35% above pre-pandemic. There is still lack of supply. And what is going on with the new listings? They're down 11% month over month in January and came to the lowest levels in 15 years outside of March and May 2020. With sales up a bit and new listings down by double digits in January, the sales to new listings ratio shot to 89.4% compared to 98.7% in December. This was the second highest level on record for the measure, only slightly below the record 90.2% set last January. Months of inventory held steady at a record low 1.6 months. With such an imbalance in supply and demand, price ripped higher by a record of 2.9% or $24,000 in January alone. The year-over-year increase hit a record of 28%. The winter months always have the lowest level of active inventory. There's a lot of seasonality in both sales and inventory trends, and both tend to be the lowest in December and January. There were only 70,000 homes listed for sale on the MLS at the end of last month. That's as low as it's been for at least 30 years. When you pull forward demand into a period of seasonality, low supply prices tend to squeeze higher. And when the supply is not just low, but at 30-year lows, the chance for dramatic moves in price is magnified. As we head into the spring selling season, we'll probably see a new listings pick up as we have in February, and that should help alleviate some crazy monthly price gains we've seen over the winter. I believe, in my opinion, we're setting up for a significant slowdown in the back half of the year. We'll probably see a very strong, if not chaotic, spring selling season as buyers try to frontline the interest rate hikes and potential mortgage rule tightening for investors into a market with low inventory. By my math, based on the data from the Bank of Canada, that slightly more than half the increase in sales since 2015 is attributed to rising prevalence of investors and second property owners in the market. Homes today are selling at levels well above any comparables. It's one record after the other. Now, we did see more listings come up in February and a ton more in March. As I've indicated, we'll see a gradual slowdown from a seller's market to a more of a balanced market after this crazy spring season and into the summer. Number 3, supply and demand and increase to federal immigration targets. The federal government has raised immigration targets, including bumping up its year's target from 411,000 to 432,000. The government is now expecting to welcome 1.3 million new Canadians in just the next 3 years. That's a lot of new housing demand. In my opinion, there'll be a lot more as we take in additional refugees from the war from Ukraine. The good news is the building permits remain at record highs, which signals strong future development activity, all else equal. And what's particularly encouraging is that single-family permits are at the highest levels since 2013. Developers are bringing plenty of new supply to the markets. It's just that it's being readily absorbed. Completions have surpassed 205 units over the past year, but the inventory of completed and unsold homes is at the lowest it's been since 2004. Home equity line credits are back. The typical home in Canada has risen in value by $183,000 over the past year. This is a huge increase in equity, as homeowners also have the ability now to unlock their home equity line of credits. Thus, it should be of no surprise that HELOCs balances are once again growing. Balances at chartered banks have now posted back-to-back 0.7% monthly gains that have pushed the 3-month increase to the highest since 2012. People are borrowing money and using their HELOCs to do it. Analysis indicates consumer insolvencies remain low for now. Consumer insolvencies fell another 7.7% year over year in December, and were 33% below 2019 levels. Insolvencies remain at a 20-year low across the country. However, could tax debt issues drive a significant increase in insolvencies in 2022 as various government relief measures will run out? What could happen in 2022 that would increase tax-driven insolvencies? Well, for instance, stronger CRA collection actions on debts will resume. They've been pretty lax for the last 2 years due to COVID, but I think they will be getting a lot more aggressive now. Next, ending of interest relief on COVID-19 benefit tax obligations. And lastly, the upcoming 2021 tax filing obligations. With the upcoming filing deadline for 2021 taxes, more Canadians will face an outstanding tax bill when they file their taxes. Lastly, your mortgage market update. Fixed mortgage rates continue to rise, and variable mortgage originations surge. The best discounted 5-year fixed mortgage rate is now about 2.8%, up about 130 basis points off the December 2022 lows. But with variable rate mortgages still around 1.2% range, there's still plenty of cheap financing available for now. The gap between fixed and variable rates has widened to about 160 basis points, the most since 2010. Now, total mortgage originations were down 19% year over year in December, but the hides a sharp divergence between variable, which is up 84%, and fixed rate originations, down 58%. Variable rate mortgages remain extremely popular, accounting for 54% of all new mortgages in December. They now account for over 28% of all new mortgage debt. In conclusion, the Bank of Canada will continue to raise interest rates, which will increase mortgage rates. The response in home sales will be an increase in demand as buyers try to get into the market to beat the increase over the next few months, with a tapering and stabilizing as summer approaches. The increased immigration targets will also hamper supply as builders try to keep up with the demand. Consumer insolvencies may increase as the government cuts off income supports and subsidies. As mortgage rates increase, buyer borrowing power will be reduced. For those looking to make a move, I would advise doing it sooner than later. It's only a matter of time when the real estate market shifts from a seller's market to a balanced market and then to even a buyer's market. To obtain top dollar for your home, sell now, negotiate a long closing. This will allow you to realize top dollar at the peak of the market while you take your time to look for a new home as the market cools. This is Jesse with the Jesse Banwick Group with eXp Realty. We help buyers and sellers make nice moves.